Welcome to our class today, and today I want us to be able to have a discussion on what we call the statement of financial position. We did the income statement, which is actually part of the final accounts, which we call the financial statements. And today I want us to be able to discuss about the statement of financial position, which we also call the balance sheet. So the statement of financial position is also known as the balance sheet, and the function of the balance sheet is that it shows the financial status of a company in terms of the asset base and also the liabilities that that particular company has to pay. So we'll be able to have the format of that particular, the statement of financial position, and I'm going to prepare the format that looks like a question. So therefore you are going to have a detailed understanding of it. So you are going to be given a question, maybe ABC Enterprises. ABC Enterprises statement of financial position. Statement of financial position as at 31st December maybe 2019. So in the exam situation, they are going to be able to ask you prepare the statement of financial position as at a particular date and a particular year. That's how you are going to write that particular wording. ABC Enterprises statement of financial position as at 31st December 2019. So when it comes to the income statement, we said it is prepared for the year ended. So if it was to be the income statement, we were to write ABC Enterprises income statement for the year ended. But if it is the balance sheet, which is the statement of financial position, we usually say as at 31st December, that particular, the 2019. So now, this particular, the statement of financial position is going to have 3 columns. So you're going to be able to have 3 columns. The 3 columns that way. So you have another one here, and then so you have those particular 3 columns, which is the statement of financial position is going to have the 3 columns. The first column is going to contain what we call the costs. The second column is going to have what we call accumulated depreciation. And then the third column is going to have what we call the net book value. And you know very well that from the adjustments of the books of accounts, if you want to find the net book value is basically, you have been given maybe the cost of an asset is 20,000, and then the accumulated depreciation is maybe 5,000. For you to be able to get the net book value is always given by taking the cost, which is going to be 20,000, minus accumulated depreciation, which is 5,000, and therefore you are going to have the net book value as 15,000, as that particular 15,000. And when we talk about the net book value of an asset, the net book value is basically the second-hand price. The second-hand price of a particular item, especially machinery. So whenever you sell something at the using the second-hand price, especially the machinery, that's what we call the net book value. So for example, we are going to be able to have some of the assets, and then we'll be able to get the net book value by taking the cost and then subtracting that particular accumulated depreciation. So we always start with the non-current assets. When preparing the statement of financial position, we are going to be able to kickstart with the non-current assets. And I want to remind you that whenever we prepare this particular statement of financial position, we are going to be able to, we are going to be guided by the accounting equation You know very well that the accounting equation is assets is equals to capital plus liabilities. So this particular accounting equation is going to be able to guide us on how to prepare this particular statement of our financial position. So we are going to start with the assets, and then we will go to the capital, and then we will actually clear with the liabilities there. So I want us to be able to assume that some of the non-current assets that we have furniture. So I'm going to be able to write furniture here. And let us assume that the cost that you have been given in that particular equation, in an exam situation, maybe they have given you the cost is 4,000. So I'm going to be able to write 4,000 under the cost, just like that. And then they are also going to give you accumulated depreciation. So let us assume that the accumulated depreciation that you are given is maybe 1,000. So we're going to be able to capture that particular 1,000 in the second column, and then the net book value is going to be 3,000. So the net book value is going to be 3,000 in that particular case. So now, we have said that for you to be able to arrive at the net book value is always given by taking costs minus that accumulated depreciation, and then you are going to be able to arrive at that particular net book value. And then let us assume that another asset that you are given is machinery, and the cost is maybe 5,000. Accumulated depreciation, let us assume that they have given you 2,000. So you will capture that accumulated depreciation there as 2,000. And then again, the net book value here is going to be that 5,000 minus 2,000, which is actually going to be 3,000 in that manner. And then we can be given land also as a non-current asset. And we want to assume that the value of land maybe it is 4,000. And let us assume that you have not been given the depreciation of land, because land does not depreciate, it rather appreciates. So you are going to be able to put a dash here under that particular accumulated depreciation. And then it's like now whenever you put a dash, it means that the accumulated depreciation is 0. So it's like 4,000 minus 0, which is going to be 4,000. And let us assume that these are some of the non-current assets that you are given. In the examination situation, they can actually be able to give you maybe 2, they can give you 1, whichever that they're actually going to give you. So you're going to be able to add, and you're going to take this particular, the 4,000 plus this particular 5,000 here, and then plus this particular 4,000. And then also you'll be able to add this 1,000 plus the 2,000, and also in the other side under the net book value, you'll be able to add 3,000 plus that 3,000 plus that particular the 4,000. So now this one is going to be 13,000. So it's going to be captured here as 13,000 below this line here. And then this one is going to be, if you take 1,000 plus 2, it's going to be 3,000. And then this one is going to be 10. It's going to be 10,000. So it's going to be 10,000 in that particular manner. So now that's how you calculate it, by just adding. And then the first 2 columns, you are going to cross them with a double line. The first 2 columns, you cross them with a double line. And then after doing that now, you're going to go to the current assets. So you're going to write current assets. The current assets, that's another thing that you're going to be able to write, which is going to be the current assets. And the current assets, we're going to start with inventory. Inventory, and remember that the other name of inventory is basically stock. So we're going to capture inventory, and you're going to capture it under the second column. So So let us assume that inventory was 1,000, so you capture it here. 1,000, and if maybe they have given you two types of inventory, that is opening inventory and the closing inventory, we always take the closing inventory. So the inventory that goes to the balance sheet or the statement of financial position is always closing, just in case they give you two types of inventory. The one that is going to be captured here is going to be the closing inventory. So that's what you need to be able to know there. And then what follows inventory is going to be accounts receivables. Accounts receivables. So account receivables, the other name of account receivables is debtors. Debtors are the people that are owing you. Anybody that is having your money is supposed to pay you. That's an account receivable, and that individual is a debtor and is an asset to you. So that's why they call account receivables, because you are expecting to receive money. Receivables, you are going to be able to receive money. So let us assume that the account receivables, maybe it was 500. So you capture it as 500 that way. And then we can have cash at bank. Cash at bank, the money at the bank is an current asset. Let us assume it is 300, so you capture it there as a 300. And then let us have the cash at hand. That's also a current asset, and then you capture it here as 200 maybe. And then you are going to add the 1,000 plus 500 plus 300 plus 200. And which you are going to get is 2,000. So the 2,000 you push it here. So you put a line, and then on that same line you push it to the third column. You put that 2,000 there. So now that's the total, the totals of the current assets, which is 2,000. You push it here, and you are going to take 10,000 plus 2,000, which is going to give you 12,000. And now this is going to be, you are going to cross it with a double line, and you are going to call that particular figure of 12,000 total assets. The total assets. So those are the total assets, and the total assets is basically taking the non-current assets plus the current assets. You have your total assets, the total assets in that particular manner. So after doing that, we are done. This means that we are done with the asset part. Remember, we are preparing the statement of financial position, strictly following this particular accounting equation. So the accounting equation is the one that is going to provide you. So we are done with assets. Now you go to capital. So you are going to write below here, financed by. Financed by. So you want to be able to know what finances this particular total assets. The moment you have a company, whenever you have that particular company, you have to be able to have assets, and what is going to finance this particular asset of ours. So the assets, the 12,000, they are going to be financed by the capital. So that's why you are going to move to the next category, which is capital. So financed by, you write capital. Write that particular capital, and let us assume that the capital was maybe 9,000. So you put that 9,000 here as the capital in the third column. 9,000, which is capital, and then we are going to add net profit. If we have been given net profit, we add it to the capital, net profit. So let us assume the net profit was maybe 1,000. So you capture that 1,000 here. You add it to the capital. If it is a net loss, if it's going to be a loss, then we're going to say less net loss. You subtract. If it was to be a net loss, and whenever you subtract, you are supposed to put that figure inside a bracket. But now we want to assume that this is a net profit. So therefore, we are going to add that particular the net profit there. And then you less drawings. So sometimes you can take a certain amount from your business for your own personal use. So that one usually is going to decrease the capital. So you have to less it. Let us assume the drawings were, it was also 1,000. Just make an assumption. So it is going to be 9,000 plus 1,000 minus 1,000, which is basically going to be 9,000 here. And this particular 9,000, we can call it net capital. The net capital. So we have adjusted our capital, and it is a net capital there. So which means again, the moment we have calculated up to the net capital, we are done with the capital part. Remember again to remind you that we are strictly following this particular accounting equation. We started with assets, the non-current and current. Now we are done with the capital. The next part is going to be liabilities. So because of the space here, you can see that I do not have enough space, so I will go to the other part. The second part of the whiteboard here. So it's just a continuation. And now in this particular continuation here, we are going to have now liabilities. The liabilities, that's what you are going to have there. And the liabilities, we can actually combine both the non-current liabilities and the current liabilities. So for example, you can have bank loan. You can have the bank loan. So bank loan is an example of a non-current liability whenever we talk about the bank loan. So we can capture it here. So let us assume that the bank loan is 2,000. You put it in the last column there. And then we can also have accounts payables. Accounts payables, these are creditors. These are suppliers that you are actually supposed to be able to pay. So you can write accounts payables, and let us assume that accounts payables is 1,000. So you capture it here. And you want to be able to assume that those are some of the liabilities you are given in acquisition. You are just making an assumption. Remember, this is a format that looks like acquisition, which is going to help you a lot. You are going to take, now we are done with the liabilities. And remember, from this accounting equation, it usually states that we are going to add capital plus liabilities. So our capital, which was 9,000, the net capital, we add the total liabilities there. So it's going to be 9,000 plus 2,000 plus 1,000 there, which is going to give you 12,000. So that one is going to give you 12,000, and this particular 12,000 is going to be, so we are going to put this particular 12,000 here, and this is going to be total. So it will be total capital plus liabilities. So you take the total capital plus liabilities in that particular way, and that's how you are going to do it. Total capital plus liabilities, which is going to be the 12,000. And you can see that the total capital plus liabilities should be equal to the assets. And that's why when you will say that now the balance sheet has actually balanced, the total assets that you see here should be equal to capital plus liabilities. So capital plus liabilities that we have added there, which is 12,000, should be equal to the 12,000 that you can actually be able to see here, which is the total capital plus that liabilities in that particular manner. And that's how you prepare the statement of financial position in that manner. You start with the assets, both the non-current and then the current, you add them together, you get the total assets, which we did here, and then you go now to the capital. Of course, they are going to give you the capital, and You can see the capital you are given there. You add the net profit if you have been given. You less maybe net loss if they have given you a loss. You are going to less drawings, and then we arrived at the net capital here to be 9,000. So this was 9,000 here, and then you go to now liabilities, and you can see that liabilities is we have the bank loan and also the accounts payable, and then you are going to be able to have the total capital plus liabilities. So that's how basically you prepare what we call the statement of financial position by just following that particular format. So the moment you follow that format and you're going to be guided by the accounting equation, then you can actually be able to prepare the statement of financial position perfectly well. So maybe in the next class we will have a question, and then you will be able to see how it is going to be done. But this is just like a question, and it will guide you accordingly. So thank you.